Hello friends, welcome to Gurukul Live lecture series. I am Dr. Divya Varma, and in the series of financial markets and institutions we were talking about how to invest in stock market. So this is in continuation to that lecture. We will be talking about how to invest in stock market and some basic things which all of you should know about stock market. Companies issue shares to get capital for the investment through IPOs or public issue and get it listed on stock exchange for further trading in the stock market. The shares which are listed on the stock exchange are categorized on the basis of market capitalization. As we discussed earlier, market capitalization is share price multiplied with number of shares. Now you can be a trader or investor in the share market. Traders hold the stock for a short period of time, whereas investors hold stock for a longer duration. As per your financial needs, you can choose choose any of the investment product that is available on any stock exchange. Now talking about all the companies who are listed on the stock exchange and their the market capitalization and the prices which are reflected. So to have a categorization of these shares into some index, so all stock markets, they have developed their own indexes. For example, National Stock Exchange has an index called CNX Nifty, which is a composition of 50 shares. Similarly, Bombay Stock Exchange have their own index, which is known as Sensex. It is a short form of sensitive index and it is a composition of 30 top stocks. Now, stock market indexes are meant to capture the overall behavior of the equity market. A stock market index is created by a selected group of stocks. They are representative of the whole market or a specified sector or segment of the market. An index is calculated with reference to a base period and a base index value. Stock market indexes are useful for a variety of reasons. Some of these reasons are that they provide a historical comparison of returns on money invested in the stock market against other forms of investment such as gold or debt. They can be used as standard against which we can compare the performance of the equity fund. As a lead indicator of the performance of the overall economy of the sector, stock indexes reflect highly up-to-date information. Modern financial applications such as index funds, index futures, index option play an important role in financial investments and risk management. Now, there are various types of indices that exist. Some of these are like broad market indices. It consists of large liquid stocks which are listed on the exchange. They serve as benchmark for measuring the performance of the stocks or portfolio such as mutual fund investments. For example, CNX Nifty 50, Sensex, they are broad market indices. Then we can have sectoral indices. These comprise of specific sector companies. For example, Nifty Bank Index, Nifty Pharma Index, S&P BSE Energy, etc. There can be thematic indices which are based on categorization of companies according to certain themes like S&P BSE 500, Sharia, Nifty CPSE Index which represents the public sector enterprises companies. There are strategy indices also. Now, these are designed on the basis of quantitative models, investment strategies to provide a single value for the aggregate performance of a number of companies. It includes indices like Nifty Equity Saving Index, S&P BSE Sensex Futures Index. There are fixed income indices also. Now, these are used to measure performance of the bond market. The fixed income indices are a useful tool for investors to measure and compare performance of bond portfolio. Fixed income indices are used for introduction of exchange traded funds. For example, Nifty AAA Corporate Bond Indices, S&P BSE Index, India Provincial Bond Index, etc. Now, the purpose of these market indices is it helps in market representation. Like the CNX Nifty 50, these stocks represent about 65% of the total float adjusted market capitalization of the whole stock market. The list of companies which form a part of the index, they get revised from time to time. The CNX Nifty is computed using a float adjusted market capitalization weighted methodology. So that means the market capitalization is adjusted with the float. That means the freely floating shares are only taken into consideration for calculating the freely floating market capitalization for the purpose of getting a company added to the index. And then weighted average of all the companies' market capitalization is done, so that every company has certain weight based on how much market capitalization it has, wherein the level of index reflects the total market value of all the stocks in the index relative to a particular base period. So, when this Nifty index price is calculated, value is calculated, it is on the basis of a base period. Now, selection of index set is based on companies who fulfill certain criteria, that is related to liquidity, how much liquid the share is based on the impact cost, float adjusted market capitalization, and they should be eligible securities as per the norms which are set. Now, some other popular indices are CNX Nifty Junior, LIX 15, LIX 15 Mid Cap, CNX 100, CNX 200, CNX 500, Nifty Mid Cap 50, CNX Small Cap Index, India VIX, sectoral indices. So, all of these indices exist in many of the stock exchanges with different names. Now, these I am talking about the National Stock Exchange names. Now, the index, which is a barometer of the stock market performance. So, when various stocks, so when we talk about that Sensex is going up or Nifty is going up, we are trying to say that the overall the weighted average stocks or the most representative stocks of the stock market are moving upwards if Nifty is going up or if Sensex is going up. But when Sensex or Nifty is going down, we say that stock market crashed today, or the stock market is going down, or there is a bearish phase. So, we are talking on the basis of the most representative shares of that stock exchange. Maybe that Nifty is going down or that Sensex is going down. So, rather than talking about individual stocks, which we can obviously see, but overall when we are talking about the whole market, we look at these indices. That's the main purpose of having these indices. Now, when a bull phase comes or a bull market signifies, it signifies optimism, positivity, and reflects investor confidence in the market. People have a sentiment that prices would go up. So, when market index move upward, we say it is a bull market. When and in a scenario, it is bear market when there is fear which grips investors, and investors start selling their stocks as they feel that the prices of these stocks are poised to go down. Now, prices of stocks keeping going down in a bear market. So, when market index, that is Sensex or Nifty or any other particular index, it is moving downwards, we say that bearish phase has come. Now, talking about these barometer of the stock market, let us understand that as an investor, how we can make our money grow. As last time I also discussed about that an investor is interested in how much return he is getting from the market. So, he can get the return in various ways. One way is getting the fixed return, that as an investor, when you buy equity shares of a company, you get dividend. So, you are paid annually. The profit which the company earns, that gets divided over all the shareholders, the amount of dividend which is declared by the company, which is so that amount of profit which is distributed to everyone is known as dividend. So, the amount of dividend which is distributed is the income of the investor. So, that's the regular return. But there can be other investors who are also interested in capital gain. Now, how capital gain would come up? That when, let's say, you bought shares in an IPO where you could buy it at a very low price, or when you were buying shares the price were lower, and after certain period of time the price has gone up. So, if the share price which is at present going on is higher than what you have purchased it for, and if you sell those shares today, so you will get you can say positive returns, which is known as capital gain. So, if that money was invested for a long period of time, then that capital gain would be, then that gain will be known as capital gain. Many times a company can also be interested to buy back the shares. So, buying back means when the company wants to buy back the shares from all the investors. So, they would offer the shares at a very lucrative price, and then one can buy back those shares. So, as an investor, our investment will grow when you buy low and sell high. That means anything which you want to buy, any share you are trying to buy, if you are able to buy it at a low price and you are able to sell it at a high price, then this shows that you have earned profit. Now, this can come in a short run. If you have strategically invested, that means you look for an opportunity in the market that whenever the price is low, you buy the shares. And whenever the price goes up, you will wait for that certain amount of returns which you are expecting from the market, and at that time you will sell the shares. Then in the short run also, one can earn profit in this market. Otherwise, in the long run, when companies grow and the share price increases in the market over years, then also somebody can earn capital gain, which can be a good amount of money. The share prices, now what leads to, because as an investor we are interested in dividend, that is regular returns on the shares, as well as we are interested in the capital gain. So the share prices in the stock market are affected by the forces of demand and supply, as well as the fundamental factors. Now there are two things which are going on. The stock market, it is volatile. On daily basis there are buyers and there are sellers which are existing for particular shares. So there are people who are creating demand and there are people who are supplying the shares. So whenever the demand and supply forces meet together and they negotiate a particular price, so that becomes the closing price for the day in the market for a company's share. So that's how the prices get decided in the stock market. Another way of deciding the prices is the fundamental factors. If a company is doing good, is earning profit, then automatically the wealth of the company will increase, the profits will increase, the net worth will increase, and we will see that the market capitalization of the company is growing, as well as the share price is also growing. So ultimately, the growth in the share price can happen because of these reasons. And how the stock prices get affected, another important factor is the perception of investors. How do investors perceive about a company? If the investors have a positive impression about a company, then they will create demand for that particular share. So then they would like to buy that particular share, and they would buy it at a price which is quoted in the market, or maybe at a little higher price, because they do not want to lose the opportunity of buying the share. So perception of the investor about the company matters a lot. Now these factors which can affect the perception of the investor can be related to the financial performance factors. Now these can be the factors related to the financials of the company, like how much profit company has earned, what is the net worth of the company, how much dividend they have declared, what was the operating profit, what was the gross profit, net profit, and such other performance indicators. Then there can be operational factors that can affect bring up the positive or negative news about a company. Now these operational factors are related to growth factors, that the sales of the company is growing, production of the company is growing, cost is being cut down, the company has adopted newer technology, which is a positive news that can bring in a lot of positivity, and people can have a positive impression and want to buy the shares of the company. Then it can be because of management decision making. Now if management has taken up certain decisions of like mergers and acquisitions or some other important product launch, then any such changes in the management decision making, as well as any changes in the management, can affect the stock prices, because the perception of investors will change. Suddenly people will start buying that share or start selling that share based on how they have perceived overall about that company. Then there are external environmental factors which can have an impact on the company, like budget, adopting GST or any other taxation method, corporate governance norms, compliances, trade relations. So all of these things also affect. Now talking about how perception of the investors can be affected, let us say that a company has announced about that they have earned some profit, and they also define that what will be the future estimated earnings of the company. So in that case, we will see that when a company has earned profit, a company declares profit, and in the newspaper it say that quarter 3 or quarter 2 profits of the company has gone up by a certain percentage. So people carry a positive impression. That means company is earning profit, company is doing good. So let us buy the share of the company, because in future also it will be doing good, and it will earn give good returns, so let's buy the shares. When a company comes up with the news that the company is into losses and has lost some money or has not earned the profit as per the expectation, so that carries a negative impression in the mind of the investors, and they may feel that it's not the right thing to buy the shares of this company, and they would like to disinvest from those shares. Then if a company announces dividend, so we read in newspaper, we hear the announcement that the company has declared dividend. So whenever a company declares dividend, it is a kind of a positive news which the company has come up with. So such a positive news the investors carry a positive impression about it, and the people would like to buy the shares of the company, assuming that this company is regularly paying dividend. So if they will buy the share of the company will pay them regular dividend in future as well. Whenever a company comes up with a new product launch or comes up with a product recall advertisement kind of scenario, so that also is a kind of reminder in the minds of investors when they consume the product, and when they see that a new product has launched, that means the company is spending money on innovation. The company has certain vision in terms of how they are going to expand their business in future, and if it is an innovative product, then many people would like to associate with that company for future purposes, because they see that there is a growth prospect and they have launched a very kind of contemporary product which they would like to associate with that company by buying the share of the company. When a company gets a new contract, let's say a company ends up getting a big contract, or starts manufacturing at a new location, or takes up new location projects, so in that case that is also a positive news. And because all of these news, they carry a growth perspective about the company. So if a company is growing, having growth perspective, so any investor would like to invest in a company where they feel that their money is going to grow, their money is going to multiply, and the company is safe enough to invest, because the company is not going to lose its business in a short period of time. There are companies who have certain scenario where they go for employee layoffs. So if a company is laying off employees, which is a bad news, let's say, and which is not giving a positive impression about the whole industry. So if there is an industry related news or a company related news that a company has laid off some employees, so that is a negative news, and maybe people would carry a negative impression about it, and people would not like to get associated with the company and would like to sell those shares as soon as possible, because they feel that if the company is laying off now, so maybe in future there are some more downtrends which are going to come about the company. Whenever a company gets involved in a merger or acquisition, then people build up their impression that what is the reason why the company is going for a merger, or it is getting taken over, or it is going to take over some other company. Any merger, acquisition or takeover somewhere signifies that the company is growing, shows the futuristic perspective of the company, and if the impression about that merger is like it's a positive move, then any such merger, before any such merger would take place, with the announcement only you will see that share prices started going up, because the number of buyers of those shares become larger as compared to the number of sellers who are selling the shares, so they push up the prices of the shares before any merger which is being launched. Any change in the management of company, that if let's say Infosys, Narayan Murthy has left the seat, or left the chairmanship of Infosys, and then Vikas Sikka has joined. So any change in the management, because a person who is sitting on the top position as a CEO, as a managing director of a company, he carries a vision, he has a leadership quality, and whenever he is going and somebody new is coming, so every person comes up with their own let's say vision statement and the kind of work style of working they have and their management decision making. So that can, depending upon who is joining the company, that will decide that whether investors are happy about this change or not happy about this change. If they are happy about this change, they would like to be associated, remain associated with the company, and would like to buy more shares, or will not sell their shares. But if they do not welcome that particular idea, then people would start selling those shares, because with a change of management, everything of the company will change. Now, whenever a news comes that there are accounting errors or scandals that has happened, as we remember that PNB scam had come, Nirav Modi PNB scam was there. So suddenly next few days we could see that PNB stock prices have really gone down, and there was trust of investors that was shattered for few days, and nobody was ready to, they could not even imagine that a public sector bank like Punjab National Bank can have such kind of fraud that is happening over, and they would not like to get associated with that company anymore. Then there are macroeconomic factors that can affect the investor perception. These macroeconomic factors can be related to economic growth, the GDP of the economy, whether the economy is going through a boom phase, peak, recession, depression, or recovery phase. So based on that phase, the stock market will also get affected. That's what we were talking about, the systematic risk factors. Then there are sectoral impact of budget announcement. Now, budget is a very important event in the financial sector, in the financial markets. So whenever a budget announcement is happening in the month of February, the union budget is announced, everybody is hooked onto their TV screens and mobile screens and want to see that what is being announced in the budget, because any such budget announcement is going to be related to the policy announcements towards various industrial sectors. So what will happen in which particular sector, how much taxes have increased, how much new grants have been given to a particular sector, and other rates and taxes which are defined. So they help assess anyone that whether that sector is going to perform better in future. If that particular sector is going to perform better in near future, then people would start buying the shares. So we can see that during the budget period, the volatility in the stock market increases, because people are not very clear that whether the price will go up for this particular company share or will go down. So accordingly they have their own perception and they decide. Whenever any government policy comes up, new policy comes up, or any policy changes, for example, from shifting from the indirect taxation to the goods and service tax. So that was a welcome move by many companies, and not a welcome move by some of them, but adapting GST over all these years, companies have now overcome all of that. So some companies which could easily manage and sail through the GST process, they were able to manage, and they were able to strengthen their profits and whole management well, and their share prices stabilized after a certain time period. But there were some small scale companies or small businesses which could not manage it so well, and they took little longer time to manage the GST implementation in their organization. So their share prices were fluctuating much more. As soon as demonetization was announced, we could see that the stock market became highly volatile, and people started disinvesting from the market, because there was a lot of cash crunch. In case of Make in India, Skill India, Digital India, Jan Dhan Yojana. So whenever a new policy will come, depending upon what policy is going to affect which particular sector, the price of that particular sector shares increases or decreases. And then we could see more number of companies getting listed, more number of people getting associated with the Jan Dhan accounts, and all of these were positive policies which have come up in India, and then the stock market has positively reacted to these. Then any changes in the regulatory norms by Ministry of Corporate Affairs, by SEBI, from time to time when they come up with new norms, or RBI, so they do affect the perception of the investors, and accordingly the prices in the stock market. Implementation of IFRS, Ind AS has brought in more confidence of international investors in India, and then that has helped in growth of the economy. Like Companies Act, corporate governance norms, new CSR norms, taxation reforms. So all of these reforms, they bring, when they come up, they bring certain kind of disturbances, or you can say little bit volatility in the market, and later on if these moves are welcomed and they are stabilized, the policies are implemented, then the markets become really stable about it, and then trust of the investors in the market also increases over time. Any inflation related news, any inflation related changes that happen in the economy do affect the investors' decision making in the stock market. If inflation will go up, then investors' expectation from the stock market will increase. When interest rates go up, then also that affects the investors' decision making related to whether they want to invest or disinvest from the stock market. Political stability. Very recent thing that has happened was that the central government elections that has taken place. So the new government was formed, and during this election period, we could see that the volatility in the stock market was really high. Apart from that, foreign exchange rate between US dollar with pound sterling, with yen, with yuan and other currencies, that also affect the stock market prices in the economy. The kind of international trade relations we have with India and other countries, that also affect our relationship, and those companies which are importing or exporting goods from these countries, so their profitability, their things get affected. Apart from this, the other commodity markets like gold prices, oil prices, agricultural commodities, real estate, they also affect the prices and the investments in the Indian stock market. Now let's talk about whenever war takes place. So whenever there is a political unrest, or whenever there is a war-like situation or terrorism attacks that have happened many times in India. So whenever any such attack happens, that also affect the stock price volatility and the market fluctuations. So as per this graph, which you can just see, that what was the short-term effect of various wars that have taken place at different time periods. So the Kargil war, we could see that overall effect was positive over 1 week changes in the prices, but the recent Pulwama attack, if you see on 14th of February 2019, so 1 day effect in the stock market was minus 0.44%, and 1 week effect was 1.75. So you could see with other attacks also, attack on Parliament in 2007, the Samjhauta Express blast, Mumbai attacks. So all of these have led to the negative, the fall in the stock prices, because suddenly people get scared. There's a lot of fear in the market, and people do not want to invest in a risky market like stock market, because they are uncertain about their future. Apart from that, crude oil prices also have a very big impact on the stock prices. Whenever the crude oil prices, the international, because India is importing a lot of crude oil, so whenever the crude oil prices get lowered, it is positive for India, because almost 85% of Indian requirement is imported, and it will also be a positive development for other industries like aviation and paint industry, which are using oil as a raw material. Apart from that, foreign institutional investors, they play a big role. As a retail investor, we have a very small portion in the Indian stock market who are retail investors. So there are other big institutional investors, Indian institutional investors, as well as foreign institutional investors who have huge investments in the stock market. Because now with globalization, the stock markets have opened for the international players as well. So the Indian equity markets are linked with all other global indices nowadays. Let's say when Indian stock market opens at 9:30 to 3:30, so that's the timing for the stock market to operate. So the morning session of the Indian stock market is driven by the Asian markets. The afternoon session is driven by the European markets. While opening, we will depend on the US stock market, as Indian equity market is closed when the US cash market is open. So the impact of the US stock market will be shown on the second day in the morning in the Indian stock market. So that's the kind of interlinkage which we have with the international stock markets nowadays. So there are a lot of foreign portfolio and institutional investors in India, and it is one of the biggest drivers of India's financial markets, and they have almost invested around 12.51 trillion in India between the financial year 2002 to 2018. And following are the few types of foreign institutional investors where they are investing. They invest their money in hedge funds, foreign mutual funds, sovereign wealth funds, pension funds, trust, asset management companies, endowment, university funds, etc. Now, how FIIs affect the Indian markets, because FII feel they see Indian market as a developing country and as a developing market where there is a lot of growth and there is a lot of returns which the market is giving. So whenever they find that the Indian market is very safe for investment, you will see that there will be huge amount of investment coming in from the FII in India. And whenever FII, because something wrong happens or something untrustworthy happens in the US economy or any other country, so they would simply pull out the money from the Indian stock market, leading the Indian stock market to a bearish phase. So very recently in 2019 only, they have taken out 90,000 crores from the Indian stock market. Before this, they have taken out this money in 2008 when the global crisis happened. And last year they have invested almost 2,000 crores in the Indian stock market. So FII outflows has increased now because of high valuations of the Indian stock market, and in US the US bond market has started giving high yields. So that is why they are those who want to invest in safe investments, so they have started investing in US bond market where they are getting good returns nowadays. So all of these factors, they affect the Indian stock market at any point of time. So it is the investor who has to decide that what is the right time for him to buy. So for the general rule of investment says that whenever the prices are low, one should buy, and whenever the prices are high, one should sell in the stock market. Now, talking about how many stock exchanges and what are various stock exchanges in India. So there were around 25 stock exchanges, out of which only 6 are operational currently, and 3 of them have permanent registration numbers. So we have Bombay Stock Exchange, National Stock Exchange and Calcutta Stock Exchange, which are active nowadays. Temporarily active are NSE IFSC Limited, Metropolitan Stock Exchange and India International Exchange. And there were 19 other exchanges who are now deregistered by SEBI. They were like Hyderabad, Coimbatore, Saurashtra, Bangalore Stock Exchanges, Bhubaneswar, Jaipur OTC Stock Exchange, Pune Stock Exchange, Madras Stock Exchange, Uttar Pradesh, Madhya Pradesh, Vadodara Stock Exchange, Delhi Stock Exchange, Ahmedabad Stock Exchange. Now, all of these stock exchanges, they play a very important role in the financial markets of the country. Talking about the equity shares, now equity share is the main source of finance for any company, and it is the main source where we are, the Indian investor is investing a lot in the equity share in the stock market. The expression of value of the equity share is in terms of face value or par value with the issue price, and then there is a book value of the equity share. We also talk about the market value of the equity share, and these equity shares, they represent the ownership of a company, and capital raised by the issue of such share is known as ownership capital or owned funds. The equity shareholders are paid on the basis of earnings of the company, and they do not get fixed dividend, but whatever dividend, whenever the company announces dividend, they will get that part of the dividend. The equity shareholders bear very high risk. It is a high risk instrument with no guaranteed returns, but usually the capital gain, if the company is performing good, the capital gain in this market can also be very high. So shareholders earn dividend on the shares. The dividends are nothing but the shares of the residual profit which the companies get. The company's market capitalization is based on the price of the share, and it is usually a measure of the firm's size based on the market capitalization. So whenever these equity shares are issued by companies, they get the listing of these shares happen on the stock exchange. As per Companies Act, the listing is not compulsory, but as per SEBI guidelines, any company who wants to go for a public issue should go for listing of securities. So, any company can go for listing of securities with National Stock Exchange or Bombay Stock Exchange, and when securities are listed in the stock exchange, the company has to comply with certain requirements of the exchange. For example, for listing a share, the paid up equity capital of the applicant company shall not be less than 10 crores and the capitalization of the applicant's equity shall not be less than 25 crores. So, when a company wants to issue shares and wants to get their shares listed, they issue IPOs. So, as an investor, how can we invest in IPOs? Now, one can apply for an IPO through the trading account or bank account. Now, some banks bunch trading, demat and bank account. Now, once you have activated your trading cum demat account, now you need to be aware about SBA, that is application supported by blocked amount facility, which is compulsory for IPO applicants nowadays. So, SBA is an application that authorizes bank to block certain money in your bank account. So, the SBA is available in the physical and the demat form. Now, this facility eliminates the use of DDs and checks, and all you need to do is to keep some money in your bank account based on how much is the application money you are going to submit. And you need to specify your PAN number, demat account number, bank account number and the bidding details in your application. So, in IPO the demand may outshine or maybe the share get oversubscribed the actual number of shares which are issued in the market. So, that will lead to any person who has applied for the shares, they may get no shares or they may get some limited number of shares. So, whatever is the amount of shares you are going to get allotted, so that amount of money will get unblocked and will be transferred to the company, and rest of the money will be unblocked in your bank account. But so, whatever shares you get, you would get a confirmatory allotment note within 6 working days after closing of the IPO process. It is also known as book build issue. So, once the shares are allotted, they will be credited to your demat account. The next step is to wait for the listing of shares on the stock exchange, which is done within the 7 days of finalization of the issue. After the shares are listed on the exchange, as an equity shareholder, now you are free to sell the shares if you want. So, that selling of the shares in the stock market after the first public issue getting listed, now that happens in the secondary market. So, once the share of the company gets listed and the shares are circulated in the market through IPO, the share becomes eligible to be traded in the stock exchange. Now, these shares can be easily bought or sold on the stock exchange. These days, secondary market are online platform where all the market participants can meet without hassle and can trade their securities. There are various regulatory bodies in the stock market, in this capital market, which are influencing and affecting and looking at how business is being done by these companies as well as the stock exchanges being operated. Share market in India are majorly regulated by SEBI, that is Securities Exchange Board of India, along with Reserve Bank of India, Ministry of Finance and Ministry of Corporate Affairs. SEBI as a regulator was established by the Government of India as per the requirement of SEBI Act 1992. SEBI was established for the purpose of to protect the interest of investors in securities, to promote development of securities market, to regulate the securities market and for matters connected therewith or incidental thereto. So, SEBI has got registration for various intermediaries who are intermediaries in the process of stock market dealings. So, there are stock brokers and sub brokers who are registered with SEBI. There are share transfer agents, they have to also be registered with SEBI, bankers to an issue, trustees of the trustee, registrar to an issue, merchant bankers, underwriters, portfolio managers, investment advisor, depositories and depository participants, custodians of securities. So, all of these are registered under SEBI Act. There are credit rating agencies, asset management companies, clearing members, trading members, any other intermediary who may be associated with the securities market have to take approval of SEBI before they enter into this particular business. So, any intermediary that helps people to invest their money in the stock market is a part of, they have to be registered with SEBI. It may be an organization or a fund manager who can act as a mediator in the market. So, secondary market intermediaries include, most important ones are stockbrokers. These stockbrokers, they help traders to buy or sell securities by charging some amount of money in terms of brokerage and any other charges. These traders can't directly go to as traders or as investors, we can't directly go to the exchange and buy and sell securities. So there has to be a mediator in between who will give us an online platform and will also act as an intermediary between we and the stock exchange. Now, we have heard so many names like Karvy stockbroking companies, SMC, Sharekhan, India Bulls, and there are thousands of other names, Angel Brokers, Edelweiss, you name, and there are so many of them. So all of these are known as stock brokers. So they are known as stock brokers, they are known as depository participants because they help us open up the demat accounts. Under these stockbrokers, they can further appoint sub-brokers. Nowadays, these big businesses, they have their own, let's say, franchisees or offices in various cities. But if they are not able to reach with they don't want to open their branch offices, then they can appoint sub-brokers. Sub-broker is also a person who is registered with the SEBI and he is an agent of the broker, and they need to have certification from SEBI. Then there are other intermediaries like merchant bankers. These merchant bankers are issue managers. They are the one who do the lead management and who do the process of IPO and help the companies to invest money. There are underwriters who help the company to get finances to get the they give a guarantee that if people will not buy the share, they will buy the share of the company. There are bankers to the issue who accept the application money, who accept the allotment money, they refund the application money of those people who have not been allotted share. They help companies to pay dividend and interest warrants. There are portfolio managers who help companies to manage the portfolio of various investors. These can be institutional investors or these can be the retail investors as well. Debenture trustees are also a part of intermediary group under SEBI. They are registered with SEBI and they help in getting details regarding compliance by issuers in terms of debenture trustees, creation of securities, payment of interest, redemption of debentures, redressal of complaints of debenture holders regarding non-receipt, non-interest proceeds due on the due date. Then there are clearing houses. All these stock exchanges have their clearing corporations. So NSE Clearing Corporation Limited, NSCCL, is a subsidiary company of National Stock Exchange, and it is responsible for clearing and settlement of all trades that are executed on NSE. So they help in the risk management of the shares. So that is why you will find that with any stock exchange there will be no defaults. So NSE Clearing Corporation was the first clearing corporation to be established in India, and it was introduced to give a settlement guarantee before it became a regulatory requirement. And it was set up for the purpose to bring and sustain confidence in clearing and settlement of securities, to promote and maintain short and consistent settlement cycles, to provide counterparty risk guarantee, and to operate a tight risk containment system. And they started their operations in 1996. Now, for as an investors, if we do not follow an IPO route, how do we start doing the stock trading? By opening a demat account. So every person who wants to do the stock trading and wants to invest in the stock market, we need to have a demat account. Earlier, what used to happen, we used to have shares in the physical format. Like anybody who wants to buy a share, he will pay the money and he will get the share certificates with his name written on it. But with this cumbersome process and to make it more convenient for everybody, it was thought that electronic shares will be traded. So all the physical shares are now converted into electronic format and they have been dematerialized. So a dematerialization process means that all physical shares of companies have been converted into electronic shares. So that process is known as dematerialization. And when we open a demat account, so it is dematerialized account. That means it's like a bank account, it's like an account which will be opened in the name of the person, and in that we will have electronic shares of various companies whose investment we have done. So for any investment to start with in the stock market, we must open a demat account. With whom we can open a demat account? We have to approach a broker or a depository participant to open a demat account. So every day, a lot of us we keep on getting these calls for opening a demat account, or we can approach to a company which is a broking company which is reliable. We can check it online and find out a reliable company which would help us open a demat account. So this demat account, once it is opened after doing the KYC formalities, once you open a demat account, they will give you an online platform which is nowadays available on mobile apps, or you can open it on your laptop or desktop, and then you can do online trading on your own. It is just like buying and selling things. So it's very easy, and with little bit of understanding one can easily learn how to buy and sell shares in the demat account. But otherwise, you can always take help of your broker in terms of giving a phone call and telling him to buy shares on your behalf through your demat account, or physically meeting him and asking him to open the account. And opening a demat account is not a cumbersome process. It is very easy, and quickly one can open a demat account. For opening a demat account, we need to have a bank account. We need to approach a broker. We need to have an Aadhaar card, PAN card, bank statement, and a personalized check to open the account. So the bank account which you will have will be linked to your trading account, so that whenever you want to buy the shares, there has to be a bank account attached to it. The money can be taken out from that bank account, and you can transfer the money to the broker, and in return you will get the shares in your demat account. So brokers serve as the intermediary between the stock exchange and the investor, and they help you carry out the trade in the share market. In return, they will charge you some amount of fees, that is known as brokerage. Then Aadhaar card is must for opening a demat account for all kind of authentication and KYC purposes. We need to have a PAN card. Now, in case you don't have a PAN card, then the broker will help you open a PAN card, because it is like you have to pay income tax on any financial transactions, so you need to have a PAN card. Then a bank statement needs to be uploaded online for the process of opening a account. There can be various types of trading which you can do once you open a demat account, depending upon how much risk you are ready to take in the stock market. So you can do short-term trading. Now, short-term trading is when a trader invests in the share for a day or maybe for few weeks to fetch certain returns, then he is known as a short-term trader. There can be intraday trader also. Intraday trader trades the securities within a day. That means between 9:30 to 3:30, if you are an intraday trader, you will buy the share as well as sell it. So in that process, you have not indulged in the process of money getting withdrawn from your bank account and demat in the share getting transferred in your demat account. So your idea of investment is, if you are an intraday trader, that you want to earn the quick profit during the day, or you want to make quick money just by having the difference of prices during the day. The day you feel that the stock market is really volatile, you would like to have think of having a intraday trading. Another type of trading is high frequency trading. High frequency trading is associated with algorithmic trading, wherein traders use nanosecond market data to develop models which functions to buy and sell securities and fetch good returns. Nowadays, computer programs, softwares, they help you develop these algos. So one can build up a strategy, and we can set a computerized command to it, and one can start the high frequency trading. But one has to be very careful while doing high frequency trading, because if you are a beginner, one should not go for high frequency trading. The safest one is the long term trading, and it can be used by anybody who is a regular investor, or who is, let's say, a fresher or a new person who has started investing money. So when stocks are purchased for a long period of time, then that is known as long term investment. So the purpose is that you buy it at a very low price, you keep the investment for many years or for many months, and then you want to sell it. Either your purpose is achieved, that means you have got the enough returns which you wanted to expect, which you were expecting from the market, or it is that you want to your objective was to stay with that company, to get associated with that company and participate in the growth of that company. That was the purpose. Another trading method is arbitrage trading. It is done by arbitrators. Arbitrators are those traders who scoop out the return from inefficiencies in the market. Arbitrage trading happens when trading benefits from the price differences in different market at the same point of time. So, when as a trader you are seeing that in two different market the same share is being traded at two different prices. So, one can think of buying in one market and selling it in another market, and whatever is the difference in the prices, that is a short term profit which you have earned. So, whatever kind of trading you are doing in the stock market, to your broker you have to pay the brokerage fees. So, what kind of charges do you have to pay on the on your demat account when you are trading for shares? Now, these rates are different for intraday trading as well as for delivery methods. So, there is a brokerage which you have to pay. For intraday trading, the rate of let us say the brokerage is low, the amount of brokerage you have to pay is low, and for delivery it is also not too much, but it is little higher than the brokerage you pay for the intraday trading. Then on whatever profit you have earned, you will pay security transaction tax, there will be service charges and stamp duty which you have to pay as per the norms of the government. Then there are SEBI turnover charges, depository participant charges. So, all of these are paid. There are various types of products which are traded on the stock exchanges apart from equity shares. There are derivative products which includes currency derivative, interest rate derivatives, equity derivatives, global indices derivatives and commodity derivatives. Then there are debt market products like corporate bonds, central government securities, state government securities, treasury bills, sovereign gold bills. Exchange traded funds are also traded on stock exchanges. There are mutual funds being traded and equity shares obviously. What are derivatives? Derivatives are those financial instruments which derive their value from some underlying asset. The purpose of having the derivative market was to manage the risk, basically for risk mitigation. Whenever a derivative contract is entered, one party to deal typically wants to free itself from a specific risk, such as currency or interest rate risk over a given time period. Now, the derivative were launched for the purpose of hedging, and better the hedge, you are able to cover your risk more. So, there are various type of derivative products which we will discuss some other day in detail, like futures, options, forwards and swaps. Then there is bond market where debentures issued by companies and the bonds issued by companies, they can be purchased, or say they are purchased and sold, and one can transact in these also. There are exchange traded funds which are like a basket of securities that are traded and they can be bought in small amount of money. So, for example, like gold ETFs are very popular, index ETFs are very popular, which are there, and then mutual fund products are available on stock exchanges. We can buy and invest in the mutual funds also, and these stockbrokers and the brokerage firms are entities registered with stock exchanges. They act as intermediaries. So, your broker will help you pass the buy orders to the exchange and will help you match the order for the same share. So, this is the whole process of buying shares through IPOs or buying and selling shares in the stock market by paying brokerage fees to the brokerage. As of now, I would like to close here today, and maybe next time we will discuss and talk about that what are the techniques of investment in the stock market. Thank you very much, and in case there are any questions, I am very happy to take up these questions.